The Dow closed at an all-time high, and it was happening as the 10-year yield ticked below 1.6%. Let's talk about whether it's time for investors to rotate. Rotate in, rotate out, rotate around. Joining us now is Gabriela Santos, a global market strategist at JP Morgan Asset Management, and Jake Walthour, CEO and co-founder of Blueprint Capital Advisors. So, Gabriela, rates go down. That's good for stocks. I understand that, unless it's reopening fears because of variants or third vaccine, whatever it is. But then you would think it's not great. But I guess if you have growth without inflation, it's fine. Are we seeing inflation, though?
Yeah, so we've seen this recent dip in the 10-year yield, about 16 basis points month to date. I think we can try to come up with a macro story for it, but it really seems to be much more technically driven. Just some demand coming back from overseas investors, Japanese investors, for example, which make up 17% of foreign demand and are seeing some juicy hedge-adjusted yields. I think for us, the question is this pause in the 10-year yield sustainable? And we would say no. We just think this is a pit stop towards a longer 18-month process of a further steepening of the curve. So that's still one major theme for us, is that yield curve steepening. For stocks, that is much more favorable for your more cyclical stocks. So we continue to advocate for rebalancing from growth to more cyclical areas like financials, industrials, materials. It is, when you come to fixed income, though, a much more challenging backdrop. It is really a bear market in core passive fixed income. So we've really been advocating continue to shorten duration and focus on extended credit like high yield, securitized debt, where you can be more protected within fixed income.
So, Jake, if we were able to reopen and grow with these crazy type GDP numbers, I mean, you watch what China reported, and let's say we get up near double-digit growth. If that is not inflationary, if inflation really is transitory, that could be good for stocks, couldn't it? If rates stayed low because it wasn't inflationary, but we did grow much more quickly.
Look, I think the message from Chairman Powell is that he doesn't plan to take the punch bowl from the party. I look at the deficit here in the U.S. getting up around 15%, and certainly I start to think that that could be inflationary long term, but I don't think that it threatens equity market valuations or contributes to volatility here over the next 6 to 9 months. I kind of feel like we're at a discotheque and they're playing that old song by Kool and the Gang, Celebrate. And people are coming off the sidelines with capital that they've had in defensive positions, some in fixed income and some in cash, and almost indiscriminately going risk on and buying equities across the board. And while that strategy may work while we're in the beginning of this reopening phase of the economy, I think as we move into the second and third quarter earnings season, as well as the fourth quarter, you're going to have to focus on stock picking. You're going to have to leave behind some of the names that rallied just because capital was flowing in, and focus on names that, quite frankly, will do better post-reopening, sort of post-pandemic. And right now, we think the sector that continues to do well will be technology. Obviously, creative destruction is here to stay on a secular basis. And we like retail. We think there's a tremendous amount of pent-up demand for retail, particularly the consumer, focusing on getting out of their house and starting to travel again. And that means they'll be buying clothes, they'll be buying airplane tickets, they'll be renting Airbnbs, and they'll be, letting loose some of the capital that they've had pent up for the last year and a half.
Shepard Smith here. Thanks for watching CNBC on YouTube.